And the last thing I have to say with tongue in cheek, but this adage goes on for miles, and I put it in almost every report in my April issue, that there's an adage that says sell in May and come back after Labor Day. And believe it or not, that adage holds true very often. And in the April edition of the Morgan Report, I said gold is topped at 3,500 and will remain so throughout the summer and maybe even longer. And so here we are, Labor Day, and it just shoots up. Round numbers in commodities in general are very important. There's a psychology that goes with it. And so whether we're talking soybean oil, wheat, silver, or whatever, those big numbers are meaningful psychologically. Oh, we got $30 silver, now 40, and eventually 50, and maybe 60, 70, who knows?
Historically, gold and silver have served as bastions of wealth preservation, particularly in volatile economic landscapes. The current market dynamics echo the legendary gold rush of the 1960s, a period marked by significant gains as investors sought stable assets amid economic uncertainty. Silver's recent rally is driven by strong buying pressure, amplified by large short positions and algorithm-driven trading. Veteran market analyst DavidMorgan notes that momentum is now in its favor, driven by both industrial demand and aggressive accumulation by nations like Russia and China. For Morgan, the real test is psychological round numbers like $40 of silver. If silver can hold above that level for a few days, it won't be a random spike. It will be a confirmed and lasting breakout. Silver's role in the clean energy transition and its growing strategic importance in BRICS financial systems position it as a cornerstone of the 21st century economy. With industrial demand projected to grow by 50% by 2030 and supply constraints persisting, the bull case for silver is both robust and enduring. Something is different about this gold bull market. While miners typically lead the metals, this time gold rallied first. If this momentum continues, DavidMorgan predicts that miners are poised to do what they've done in every bull market, outperform gold and silver by 2 to 3 times. Trade anxiety, geopolitics, and threats to the U.S. central bank's independence have driven investors to the safety of gold, sparking a massive rally in miners of the precious metal. The NYSE Arca Gold Miners Index closed at an all-time high of $1,856.98 on Friday. It's the first new peak since 2011, when investors were snatching up safe haven assets amid Europe's debt crisis and the first U.S. credit rating downgrade. Avi Gilbert, a top analyst, predicts gold could peak near $3,500 before a multi-year bear market driven by a liquidity crisis. Before we dive into DavidMorgan's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
But really, I mean, it boils down to very simply, why are we moving? And it's, as I've said before, and it sounds trite, but it is true. And that is there's more buying pressure than selling pressure. And there's been a rather large short position in the silver market, as there usually is. But we all know that the market is set as a derivative. The price in the futures market, which dictates the spot price and what coin dealers sell their metal for, and et cetera, is determined primarily by algorithms. And so at certain levels, certain things happen. The point being is that the momentum is in our favor. The algorithms are saying buy, and the institutions are buying it mostly for industrial purposes. Yet we do see entities such as Russia that's allocating silver. And you're also seeing on the gold side where China says that their insurance industry can allocate up to 1% in gold. So there's a lot more momentum in a lot of ways in both these markets. And silver, being a smaller market, gets a larger move than gold once the momentum starts. A lot of people think that the news, dictates markets. But if you look at Socioeconomics, a book that Robert Prechter wrote, who's an Elliot wave guy, and some others, studies have been done independently, several. And really, people have the idea that news drives markets. At times it does, but it's really like 25% of the time. So if you look for a news item, like, a breakdown in negotiations or whatever, and that's what drove the market. Again, it's buying pressure. Why? We really don't know. My guess would be the idea that the markets were closed in the United States so that the aftermarket or the smaller markets in China, in Asia primarily, a little bit of buying pressure goes a long ways because there's no countervailing forces going on at the same time. Even though markets open in different time zones, the New Yorkers or people in Chicago or wherever can trade in the Globex, so they can be in any market at any time if they choose to do so. So I think that really was probably part of it. That's how I would think about it, but am I right or wrong? I think really in the long term doesn't mean a lot. What it does mean is that it doesn't take much buying pressure to move this market. I think it was up over $1 yesterday on September 1st. And the last thing I have to say with tongue in cheek, but this adage goes on for miles, and I put it in almost every report in my April issue, that there's an adage that says sell in May and come back after Labor Day. And believe it or not, that adage holds true very often. And in the April edition of the Morgan Report, I said gold is topped at 3,500 and will remain so throughout the summer and maybe even longer. And so here we are, Labor Day, and it just shoots up. So I'm going to do an update for my premiums members today, later after we're done, talking about, here it is, we have proof. It's backing off in the U.S. markets right now somewhat, but it's holding a lot of the gains that it experienced yesterday. Round numbers in commodities in general are very important. There's a psychology that goes with it. And so whether we're talking soybean oil, wheat, silver, or whatever, those big numbers are meaningful psychologically. Oh, we got $30 silver, now 40, and eventually 50, and maybe 60, 70, who knows? But it's a big deal. And all we need to see really is 3 or 4 closes on close of $40 or better in a row on this kind of volume. And we have a pretty good assurance that the trend is going to continue and that we're going higher. There's not much resistance. There's only, I think I read somebody yesterday, one of my colleagues in the precious metal space talked about, I think it was only about 2.5, 3 months where we've been above 40 on a consistent basis. So we don't have much resistance at all. Very few people that bought at that level are really holding now. I'm sure there's some out there, but from a technical perspective and a psychological perspective going hand in hand, you're seeing, I think, a jump probably to, I expect conservatively at least 10% more by the end of the year, which would put us at 44, and perhaps 20% more, which would put us at 48. Time will tell, maybe this is going to sell off really quickly and we only get, couple days above 40. I doubt it. I think the momentum is in our favor. It's after, I'm laughing. It's after Labor Day. Historically, we see strength into the final quarter of the year. We're not there yet, but we're getting there. So and the miners, and I want to talk about that quite a bit, but the miners are something that really are assurance that we're in a true bull trend. I want confirmation. I want not only the miners to do well, I want them to do better than the metals. I want to see that 2 or 3x eventually, where they outperform by a factor of 3x, for example. So if gold moves up 10%, top tier miners are moving up 30%, or if we that type of thing. And we are starting to see a lot of strength in the miners, as you expressed. Well, the bear case is given by Avi Loeb. You can look him up. He is a really good Elliot guy. It sounds like I'm a big Elliot wave guy. I'm not. I've studied at a very cursory level. This man has dedicated most of his life to studying Elliot, and he's very good at it. But he gave a lecture at the New Orleans conference, the 50th year anniversary of the New Orleans Gold Show, which is one of the most well-recognized and strongest and best gold shows in the world. And he spoke right after the opener, Brian London, about where gold is going. He said it's going to 3,500, and that's it. And he sees a multiple year bear market after that. And he sees a strong case for the dollar going up. So he's definitely a contrarian. And he doesn't go into the fundamentals, but after listening to him, I came home and really thought about it because I like to look at both sides as well. And I thought, well, what fundamentally would cause that? And the fundamental case is if we get into a liquidity crisis where people just can't afford groceries, can't afford have to choose between the electric bill and the grocery bill. And we're seeing that. And so what you do is you start to see money become more valuable to the average person or harder to get. And so they start to sell off whatever they have. Not that the average American has gold or silver. They do not. The point being is that if we start to go into a deflationary push, we could see these markets cool off. That would be the main fundamental reason that you could see it. And I need to explain that a little more, Kai, if just allow me, because I wrote about it in the Morgan Report a few months back. And I explained to people that if the S&P got cut in half, for example, then that ounce of gold would buy twice as much stock, twice as many businesses as it does now, without the price of gold changing whatsoever. So the way you need to look at it is not what the paper price of gold is, but what is the value? Meaning how many barrels of oil, how many used cars, how many houses, how much stock does this buy? So I said, for example, if we saw a 5,000 factor on the major index and a $5,000 gold price, which isn't that far from 3,500, that would be a 1-to-1 ratio using that ratio. And is that unreasonable if we have a big liquidation where a lot of people that have their 401ks or whatever, stock market starts to come down rapidly. They don't get out in time. They've seen a great deal of their wealth evaporate. So that is a deflationary situation that could, I'm not saying would, but could take place.
You're looking at miners the wrong way if you're using the price-to-earnings ratio. DavidMorgan advises to look at cash flow, pointing to Newmont's 104% year-to-date surge as proof that the bull market is still early. Gold and silver are likely entering the final leg of a major bull market. The explosive Wave 3 brings the biggest gains in the shortest time, fueled by institutional and Asian demand. In conclusion, the potential breakout of silver is based on a confluence of industrial demand, historical price movements, and strategic market engagement. Investors with a long-term view might find opportunities by understanding the intricacies of these market dynamics and choosing robust, feature-rich trading platforms. As always, thorough research and risk assessment remain pivotal to successful precious metal investment strategies. Following the April Morgan report, DavidMorgan's call to shift into silver or platinum has paid off with 30 to 50% gains. Now, he's closely watching platinum, which is 15 times rarer than gold, but trades in a much smaller market. Let's get back to the interview.
I do want to make a caveat here because a PE is not a very good metric for a mining. I mean, there's a couple big books back there that are hard slogs, and valuing a mining company is much more about free cash flow than it is a PE. PE is useful at the top of the market to get an exit strategy. Can be used, but it really isn't like a retail store selling, women's clothing or, grocery store, what have you. It's not a good metric for a mining company, but people use it. It's nothing against it, but it really isn't the best metric. So I just want to get that into the record because, that's what we do primarily at the Morgan Report is analyze mining companies, not just gold and silver, but, lithium, cobalt, the rare earth elements, the battery metals, you name it, copper. I'm becoming much more bullish on copper than I was, let's say, 6 months ago. So there's a lot happening in the resource sector. And one of the best leveraged plays you can do with lower risk, not no risk, is in the mining equities. And if you start with blue chips and work your way down into a speculative section where you basically make the correct bets, meaning how much money you allocate to each tier, you can do quite well and have a balanced risk-to-reward profile. In 1979, Hecla Mining, which is right over there, I could drive to in an hour, their office, and the Lucky Friday Mine, was the best performing stock on the entire NYSE. It went from $5 to $50 in 1 year. And so I put Hecla Mining in the Morgan Report in the early days, like year 2 or 3 of publication. And that stock was at about 50 cents, and it was in danger of being delisted because there's certain rules for an NYSE stock they have to abide by. That stock went from 50 cents to $5, a 10-bagger, the same exact metric it did in 1979 when it was published all over the financial press as being the best performing stock. I gave that lecture in Calgary at an oil meeting, oil and precious metals, and said, here we are, a 10-bagger. My readers know about it. I'm asking them to cash out at this level, and nobody even knew the word Hecla Mine. So it goes back to what you said. No one was paying attention. And that, I think, is a very good, clear, clean indicator for everybody listening to this that the bull market is far from over, in my opinion, because, again, who's paying attention? Primarily, well, first of all, let's talk about the metals and the miners. So in the metals, it's almost all institutional buying on both sides, gold and silver. As far as the equities are concerned, it's a few sophisticated buyers, like some of the best known names in the hedge fund industry are nibbling at the miners, the top tiers like the Newmonts. But it's mostly retail coming back into the market and, higher prices, cure for low prices is low prices. Yeah, it's so true, though. And now they're making a move. And again, no one's really paying attention yet. And we've yet to see, anything close to the top of the market, which means there's that panic manic buying. And that, in my view, is probably a couple of years away. But we will start to see more and more interest in these, both from the retail and institutional side. From my work and others, it looks to me as if we're in the final leg up in a major bull market. And I went and, as you know, we talked about it before we started recording, and I wanted to verify, my work with Elliot wave, and I did so, and it said, I had it correct that wave 3 up. There's 5 waves in Elliot. It's usually the strongest and most dynamic move in the sequence. It's where the leg prices cover the largest distance in the shortest amount of time compared to the other waves. It often has the heaviest trading volume. It tends to be the longest and most powerful wave, though not always. It's driven by a big shift in market psychology, which we just discussed, disbelief from earlier stages, followed by recognition and enthusiasm as more participants jump in. So since I think we're in the beginning of that leg, we're seeing more and more participants jump in, but we still have a fair ways to go, meaning that retail that's given up on silver, maybe not silver stocks, but very few retail investors that bought even in the 30s are buying in at 40. It's like, I've broken even or I'm slightly ahead. Let's see how far it goes. But institutions need it, or industrial users need it. And so that's fueling the market. I think the Asian markets are more involved than they were in the past, although silver is not nearly as bought on a retail level in the Asian markets as gold is. Regardless, we're seeing that momentum change. And I do think that we're going to see, as it says, probably the most dynamic move in price appreciation in this last leg up. And again, where does it go? I'll say probably a couple more years. And just to be sincere, I have said, we got a couple years left, more than once, and probably as long as 5 years ago, and I was wrong. But, whenever you stick your neck out, it can be chopped off. But there was a false start, I believe, in 2016. Talk about that, I don't want to, but there were times when it looked like we were going to break into the next leg up, and it really didn't carry through. This time, it's obvious. Gold is well above the 2000 breakout level. It's $1,300, $1,400, $1,500 above that. Almost not quite a double, but from 2000 to 3,500 is quite a move. And it sustained it, and we're breaking out of that consolidation. Remains to be determined if it's a breakout or fake out. We have a couple more days to watch. But no, it's exciting times. Well, we were early on platinum, and we were writing about it in the Morgan Report again and again and again. And I said in the April letter, gold's topped out at 3,500 at least through the summer. And if you have new funds or you want to add to your positions, buy silver or platinum. And that was President call. I mean, it was like almost not to the day, but it was very close. And so anyone that bought at that time was up, 30, 40, 50% perhaps. There aren't too many platinum miners. I reviewed a few on a verbal update. I do these videos for the members. And but I like it. How much further it has to go remains to be determined. I think it's going to consolidate here for a while, but it's something that you should buy if you've already got gold and silver. I mean, platinum is not nearly as liquid, and it's a super small market, but you pay a price in the physical market on the buy and the sell. You pay a huge premium on the way in, and you have to take a discount on the way out. So you got to know that and be prepared for that. But it is very much a unique metal, and it's being used more in the quote-unquote hydrogen economy, which most people don't even know about. But primarily in Asia, there's been a push, not a huge one. I don't make a big case about it, but people are seeing the discrepancy between platinum being at one time, when it was $1,000, and gold 3,500 of a 3-to-1 ratio. I mean, it's 1/3 the price of gold, and yet it usually sells at a premium to gold, because depending on the stats, it's about 15 times rarer than gold. That why not buy platinum jewelry? Gold is, going to cost me this much. I can get this platinum necklace that's 3 times the size for the same money, or what have you. So there is a push into platinum, but not a big one. But again, with a small market, it doesn't take much new buying to force the price higher.
Bybit, the world's second-largest cryptocurrency exchange by trading volume, has released a new Bybit into the FX Street TradFi report as rate cut speculation ignites a bull run for gold and silver. The report sets a medium-term target of $4,000 for gold by year-end, representing an additional 14% gain from current levels. For silver, breaking above the psychologically important $50 level could trigger renewed retail and speculative interest. Do you believe this unfolding bull market in precious metals will be remembered as a turning point in the global financial system, or just another cyclical rally? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.